Good morning, students. Now it's time for your accounts class, and my today's topic, activity ratio from the chapter ratio analysis. Okay, so first of all, why activity ratio required? In my previous videos, I discussed with you liquidity ratio. Liquidity ratio required just to know about the firm's capability to pay the short-term liabilities. Okay, then I discussed already with you the solvency ratio, which means to find out the firm's capability to pay the long-term debts, long-term liabilities. Now the activity ratio, if you want to know about the management, okay, company's management using the resources invested by the owner effectively or not, okay, if you want to know about the resources they are using accurately, then which ratio required? Activity ratio, to know about the activities. So first of all, see the learning objectives, meaning of ratios and accounting ratios. Understand the uses and limitations of accounting ratios. Understand the meaning and application of liquidity ratio, and under the meaning and application of solvency, understand the meaning and application. Okay, so my today's topic, activity ratio. Understand the meaning and application of profitability ratio and apply the various ratios in the problem. So first of all, know about the key terms. First point is cost of goods sold. COGS. Cost of goods sold means your direct cost on production. Okay, example, the cost of raw material, labor. Cost of goods sold refers to the direct cost of producing the goods sold by the company, and this cost not consider the indirect expenses, okay, like selling expenses. Revenue from operation. A retailer produces the revenue through the merchandise sales, and the physician derives the revenue from the medical services she provides. So here sales in case of retailer after the sale of goods, okay, and in case of physicians when the person providing the medical services. Revenue from operation means the revenue earned by the enterprise from its operating activities carried out to earn the profits. So simply the services if you are providing or goods you are providing, in return, in exchange, you are earning the money, and this money is considered as the revenue from operation. Working capital. Working capital, like examples, sundry creditors, bills payable, trade credit, and notes payable. So here two things considered: current assets and current liabilities. To know about the company's current position to pay for the operations. The capital of the business which is used in its day-to-day trading operations. So turnover, in two sense, see the meaning of turnover. When a new employee is on leave on an average once every 6 months. So if the person is on leave every 6 months, then turnover here. And the second meaning means sales, okay, in company's accounts. When a store takes on an average 3 months to sell all its current inventory and require new inventory. So 3 months here available to clear the stock. Okay, so turnover is an accounting term that calculates how quickly a business collects the cash from the accounts receivable and how fast the company sells its inventory. So it means that how quickly you collect the money, okay. from the debtors, and also how fast, how quickly you just clear the inventory. Trade payables, yes, trade payables, your liability to pay. Okay, if a restaurant owes money to a food or a beverage company, those items are a part of the inventory. Yes, and there's a part of its trade payables. So trade payables simply, students, your current liability. Now here your liability to pay to someone. Okay, if you purchase it on the credit basis, then your liability. Okay, trade payable is an amount billed to a company by its supplier for goods delivered to or services consumed by the company in ordinary course. And if you purchase any raw material, any other thing, any accessory from the suppliers, then your liability here. Okay, and it is to be considered trade payables. The ratio analysis. So here see bache, ratio analysis, 4 parts: liquidity ratio, solvency ratio, profitability ratio, and activity ratio. And our concept here, topic, activity ratio. So activity ratio divided into 4 parts: inventory turnover ratio, then working capital turnover ratio, trade receivable debtors turnover ratio, trade payables creditors turnover ratio. For example, P&G products, you know very well. So here the data of this company, June 30th 2019, inventory turnover of this company 6.93, receivables 13.67, and payables 3.09. So here receivable of this company more and payable less. So activity ratio or turnover ratio, for example, two companies Aarti Limited and Bharti Limited have equal amount invested in the fixed asset. So here both the company invested equally in the fixed assets, but the turnover of Aarti Limited is twice the turnover of Bharti. The just here the difference, just the Aarti put it more efforts in the business. Okay, they are using the same resources. Therefore, the Aarti Limited will be considered better than the Bharti, and just because of the activities, just because of the performance. These ratios are calculated on the basis of the revenue from operations, cost of revenue from operation. So here revenue from operation, the cash generated after sales, and cost, where the costs were used with the revenue from operation, means you deducted the profits from the sales. Why is the activity ratio required? So in a business, it is important to know as how effectively and efficiently the available facilities and resources are used. Okay, how effectively the capital, the fixed assets, and working capital are used. If you want to know about these things, then which ratio required? Activity ratio. So activity ratio, number 1, inventory turnover ratio. So inventory turnover ratio of KFC, like here current 8.84. This one is the ratio of KFC. Mahindra and Mahindra, like see, inventory turnover ratio of this company 13.38, more as compared to KFC. So inventory simply your stock available in the godowns. Okay, bakeries finished bread, a completed house constructed by a home builder. So inventory is the term for the goods available for sale and raw material used to produce goods available for sale. So any raw material available in the godown, any finished product available, part of inventory. So inventory, 3 types inventory available: raw materials, work in progress, and finished goods. Like example, your raw material, your wood, and without painting your structure, your hair chair structure, your work in progress, and after painting, finished product, your chair, final for sale. Inventory turnover ratio. So here the formula, cost of revenue from operation, okay, or cost of goods sold divided by average inventory. How to find out the average inventory? So word here use average. So how many components available? Opening inventory and closing inventory. So like on 1st April the inventory and on 31st March inventory. Add up both, divided by 2, your average inventory. So how to find out the cost of goods sold? The formula for cost of goods sold, first of all, just see opening stock, add net purchases. So here why word use net purchases? The net purchases means that your gross purchases deduct the returns. If any return, then deduct it, plus direct expenses minus closing stock. This one is the formula for cost of goods sold. So cost of goods sold refers to the direct cost of producing the goods sold by a company. Means your direct cost, your raw material cost, your labor cost. This amount includes the cost of materials and labors directly used to create the goods. For example, opening stock 30,000 available, purchases 54,600 available, expense on purchases 6,000, sales 90,000, expense on sales 3,000, and closing stock 36,600. So how to find out the cost of goods sold? Your formula, you know, opening stock, purchases, expense on purchases minus closing stock. So why here in the formula expenses on purchases considered? Because this one your direct expense on expense on production, and if indirect, no need to include. So here your opening stock 10,000, your purchases 54,600, and your closing stock here 36,600. So your cost of goods sold here 54,000. It excluded the indirect expenses such as the distribution cost and sale forces cost. Cost of revenue from operations. How to find out the cost of revenue from operation? Revenue from operation just minus gross profit. Okay. Or the second formula to find out the cost of revenue from operation, cost of material used including direct expenses plus change in the inventories of work in progress and finished goods. And the third formula to find out the cost of revenue from operation is opening inventory, add net purchases plus direct expenses minus closing stock. Okay. So these all three formulas available to find out the cost of revenue from operation. Now the next part is revenue from operation. So revenue simply your sales amount after exchange of goods. If gross sale is rupees 4 lakh and the sales return is 25,000, revenue from operation here is just deduct the revenue from the revenue. This simply your return portion. Net sales will be, see, 4 lakh minus 25,000 return. So your exact value revenue from operation is 3,75,000. Revenue from operations means the revenue earned by the enterprises from its operating activities. Activities carried out to earn the profits. So practical problem, see, from the following information calculate inventory turnover ratio, X Limited statement of profit and loss for the year ending March 31st, 2017. So particulars, note number and amount given. So here directly revenue from operation in the statement given to you. Other incomes given to you, total revenue, expenses, cost of raw material consumed, change in inventories of finished goods, other expenses given in this statement. So how to find out? See the notes to accounts. First of all, cost of raw material purchase, add the value here, cost of raw material consumed. See, add opening stock of raw material less closing stock. With you the amount here 1,95,000. So change in inventory of finished goods and work in progress already given in the statement. Opening inventory of finished goods and work in progress, just deduct the closing inventory, the left out part with the company. Okay, so here the exact part negative change of 60,000. So the next ratio under the activity ratio, working capital turnover ratio. Okay, so working capital turnover ratio, for this, first of all, working capital, the capital of a business which is used in day-to-day trading operations. So working capital, gross working capital and net working capital. So here, first of all, have a look on the current assets, current liabilities, like current assets, cash in hand and cash at bank, current investment advanced against the salary, interest accrued, sundry debtors, prepaid expenses, bills receivable, fixed deposit with the bank. So current liabilities, income received in advance, provision for tax, short-term loans, sundry creditors, outstanding expenses, bills payable, bank overdraft. So while calculating working capital, you need current assets and current liabilities. So gross working capital is the amount invested in the current assets. So simply your total of current assets considered as gross working capital, and net working capital means the excess of current assets over the current liabilities, like here current assets minus current liabilities. Okay, so what is the formula of working capital? Current assets minus current liabilities, or capital employed minus fixed assets. So practical example of one company. See, following data is available from the records of the company Johnson and Company Limited. See the stock, sundry debtors, bills receivable, advances, everything available. Okay, see stock, your current assets, debtors, your current asset. Okay, receivable, your current assets, advance, your current assets, cash in hand, current assets. Your creditors means your liability to pay to the party. So here your current liability. Bills payable, your current liability. Bank overdraft, your current liabilities. Reserve 10%, preference given, equity given, net profit given. So this one is the full-fledged statement of the company. Next, solution. How to find out the working capital ratio? So first of all, add up all the current assets in the statement given to you. So add all the current assets, stock, debtor, bills receivable, advance, cash in hand. So here with you the total of current assets 1,34,000. Now it's time to find out the current liabilities. Add all the current liabilities. Okay, like creditors, bills payable, bank overdraft, everything. The total of current liabilities 1,04,000. Apply it in the formula. Current assets minus current liabilities. Your current assets 1,34,000 minus 1,04,000. Your current liabilities 30,000. So the working capital of the Johnson and Limited is 30,000. How to compute the working turnover ratio? So here the formula, revenue from operation divided by working capital. So you know how to compute working capital, current assets minus current liabilities. Practical problem number second. See, calculate the working capital turnover ratio. So here one company's balance sheet with you to find out the working capital turnover. So equity is given, non-current liabilities, current liabilities given, non-current assets, current assets given to you. Revenue from operations during the year were 42,60,000 in the statement. Notes to accounts also in the statement. So accounting treatment. What is the accounting treatment? First of all, calculate working capital. Okay. Then use the formula and calculate the ratio. So here you know that first formula working capital, current assets minus current liabilities. Your second formula to find out the working capital is with you like revenue from operation divided by working capital. So your current assets in the statement, add all the current assets minus current liabilities. With you the current assets, and after deducting the current liabilities, the amount working capital to like 10,000. Now you are having the working capital, applied it in the formula. So revenue from operation directly given to you in the statement 42,60,000. Put the value in the formula divided by working capital to like 10,000. So 20.28 times working capital, quite satisfactory level. Okay. So here how many times? 20.28 your working turnover ratio. Significance of working capital turnover ratio. Every rupee of working capital should ultimately generate revenue from operation. With the help of the working capital turnover ratio, we can measure as to how much revenue from operations are generated by each rupee invested in the working capital. So here with the help of this ratio, you just find out the money invested and how much money generated with the help of this money. Okay, the higher the ratio, the better it is. The ratio will be expressed as the number of times the net working capital is rotated. So here if your ratio higher, then good for the company. Okay, so the third ratio is trade receivable turnover ratio. For example, the trade receivable turnover ratio of the KFC is 5.6. Okay, the trade receivable means your here you are going to receive the money from the outsiders, from the parties, like bills receivable, debtors. Why trade receivable turnover ratio required? Ratio measures the activity involved in converting the receivables, that is debtors and bills receivable, into cash. Okay, so here you are going to receive the money from the debtors, and the this debtor, and when you are going to receive money from the debtor, come under the head trade receivable. This cycle of making a credit sales and then realizing the debtor should move fast. It is not good to pile up the debtors. So it is good for you to collect from the debtors the money within shorter period of time, like within 1 month, within 2 months, or with even in 15 days. Okay, provision for doubtful debts. So while calculating the average debtors or receivable, the provision for doubtful debt is not to be deducted from the debtors. Gross debtors before provisions are to be taken. So sometimes some debtors, you know that some debtors in future doubtful case, maybe pay or not. So here 50-50 chances. Okay, so for these type of debtors, one provision already created by the company, that is provision for doubtful debts. But in this case, if you want to know about the ratio, then don't deduct the provision for doubtful debts from the debtors. Okay, here you just consider the gross debtors. This is because the net debtors after provision for doubtful debts will unnecessarily increase the ratio, giving a wrong signal that the recovery of debtors is very good. So here just to know, if you want to know about the exact result, then it is quite better for you not to consider the provision for doubtful debts. Just take the gross value. Okay, therefore the provision for doubtful debts is to ignore. So here ignore, always remember this thing. In case of debtor, ignore provision for doubtful debts. So trade receivable turnover ratio formula: net credit revenue from operation divided by average trade receivable. So how to find out the average trade receivable? Opening debtors and bill receivable, closing debtors and bill receivable divided by 2. Your average trade receivable. Opening balance plus closing balance divided by 2. So practical problem C. From the following information, calculate the trade receivable turnover ratio for the year ending March 31st, 2017. Debtors, opening debtors, closing debtors given, provision, opening, closing both given to you. Okay. So total revenue from operations during the year ended March 31st, 2017 was 48 lakh, and 1/3 of the total revenue from operation was in cash. So cash revenue from operation is 1/3 of the total revenue from operation. So here cash revenue of the total revenue 1/3. So total revenue with you, just find out the 1/3 part. 1/3 part is 16 lakh, deducted from the total. Then with you the credit 32 lakh. Okay. So now the next portion to find out the average receivable. So how to find out? Opening debtors plus opening bills receivable, closing debtors plus closing bills receivable. With you 1 lakh debtors, add 20,000 opening bills receivable, add 80,000 closing balance of both the parties. Okay, divided by 2. So with you the average receivable 1,60,000. Apply it in the formula. So credit revenue from operation computed here to 32 lakh. Okay. Then the next portion, average receivable 1,60,000. The ratio here is 20 times. Okay. Trade receivable turnover ratio, your here 20%. Significance. So why this ratio required? This ratio shows the how effectively the receivables are converted into cash. Means how quickly your receivable are converted into cash form, like within 15 days, within 30 days, or even in 1 month. Okay. Higher ratio indicates that the debtors collection is good. A good collection puts more funds in the hands of management. For example, inventory turnover ratio of Hindustan Unilever Limited 14.71 in March 2020. So current year, this year. Okay. Hindustan Unilever Limited company's ratio here 14.71. Now the next, trade payable creditors turnover ratio. Okay. So payable means your liability to pay to someone. Okay. So in this case, bache, see, for example, if you want you purchase the one best example, you purchase the raw material, okay, from one supplier on credit basis. So in this case, your liability to pay to the creditor, to the supplier, this ratio shows the speed which the creditors and bills payable are discharged. Okay. Trade payables turnover ratio formula: net trade purchases divided by average trade purchases, average trade payables. How to find out the trade payables? Same, just like in case of receivable, opening balance plus closing balance divided by 2. So practical problem: from the following information, calculate the trade payable turnover ratio. So creditors opening, closing, bills payable closing, opening given, total purchases during the year ending March given to you, that is 30 lakh, and 1/2 of the total purchases were for cash. How to find out the solution? Find out this ratio. See, cash purchases, half of the total purchases, find out 30 lakh total purchases, one. So half of this 15 lakh. Credit purchases with you 30 lakh minus 15 lakh. 15 lakh is your credit purchases. Now the next part is average payables. Add the opening balance of creditors and closing balance along with the bills payable. So here 1,85,000 opening balance of creditors and bills payable 15,000, add the closing balance 10,000, add the 90,000 bills payable closing balance, divided by 2. So with you 1,50,000 average trade payable. So trade payable turnover ratio is the credit purchases divided by average trade payables. 15 lakh divided by 1,50,000 to 10 times. So here your trade payables turnover ratio 10 times. So in previous example, that is 20 times your receivables, and here trade payables 10 times. So here if you want to compare your receivable ratio more and your payable ratio less. Now it's time for homework questions. So today I discussed with you the activity ratio. Okay, under activity ratio, the inventory turnover, working capital, trade receivable, trade payables discussed. Now see the homework question. How do you compute the inventory turnover ratio? Second, what does the higher inventory turnover ratio indicate? Then what does the trade receivable turnover ratio indicate? Then what does a low working capital turnover ratio indicate? Then next question, what does a low trade receivable turnover ratio indicate? So along with the theoretical questions, solve the practical problems 49 till 80 along with the related illustration relating to this topic like activity ratio. So must watch the YouTube link, students, of this activity ratio for more better understanding of the topic. Thank you so much, students.